Everybody, this is Rob Keens with the Freedom Report, and today we're going to go over the final part of the Precious Metals Masterclass series I'm putting together. This is part three, and we're going to talk about retail prices, technical and fundamental analysis, and then we're going to do a little bit of a risk review across the whole series. If you're interested in getting investing all this, things to consider before you do. We're going to talk risk management, which is critical to having a portfolio, even if it's only $1. Risk is always important no matter the size of the portfolio. So we're going to focus on that at the end. And without further ado, let's go ahead and get into the presentation. This is part three of three, and we are calling it technical fundamental analysis and risk with a really good measure of retail prices thrown in, but that would have been too long of a title. So we're just going to stick with this for now. And this sort of brings together some of the study pieces of the first two parts, as well as adding new information for you. And a lot of people will be interested in this third part if your stackers are interested in the bullion and trying to figure out specifically what bullion to buy, at what price to buy, figuring out kind of when to get in, depending on where prices are going and stuff like that. I'm not going to do a full macroeconomic analysis in terms of why you may want to get into gold or silver, although I will cover it in some charts. So I'm going to narrate a bunch of charts and talk through that so that you have a nice visual of how gold does when measured in other things and against silver and all that kind of stuff. And I'll talk you through that. So you'll have both a nice visual and some information to back that up. And we're real quickly at the beginning, just going to do a super quick recap of part one and part two, since it may have been a while since you guys have gone through this. Now, before you get deeper into this series, I highly recommend you take it in order. If you go to my homepage on YouTube at the Freedom, I think RPT, and find me over there and go down on the homepage to the first playlist, Precious Metals Masterclass. There's part one, two, and three. Now this part in order. So I would highly suggest you review in order because I tie together the supply chain from start to finish, which is going to help you be more educated on why things occur. If you only look at one part of the series, you may not understand factors that go into determining things like availability of precious metals, the cycle of precious metals, risks on each type of precious metals, premiums, availability, and that type of thing. The whole series was really meant to be viewed together. Okay, so part three, here we go. Real quick, part one was the miners. So we looked at the mining stocks, but specifically how the miners get it out of the ground. We covered geology and exploration, that type of thing. How the geologists find it, how the metallurgists and geologists grade it, and how they develop their 43-101 resource estimates and kind of stages that go into that. Estimating the resources and quality of resources. The quality or grade of the resources matters a lot in terms of whether or not that miner is going to be able to get that out of the ground. We talked about the financials, how they finance themselves, what the financials look like over the life cycle of a mining equity. So you can kind of gauge and look at different mining equities and see which one from a financial perspective seems like a more attractive target to you in terms of where operations is going to go and where those numbers end up and end up affecting the share price, which is a key metric if you're getting into a mining equity because you're really playing the share price. But to play the share price, you really got to understand fundamentals and finance. The mining life cycle, the stages of a mining stock from exploration to full production. And there's a little chart there that kind of explains how it works. Now, that chart is illustrative of the overall life cycle of a mine, but it's not exact, meaning mines can go in different stages. Sometimes they get shut down. Sometimes somebody picks them up and redevelops them. There's a lot of factors that go into it, but we have a really good presentation by my friend Jerry Huang, who's the CFO of Impact Silver and a principal at an investment company, Gemini, who has many, many years of experience in the field and walks you through the life cycle of a mine. And then we talked about project risks. There are several key risks to know to understand when you're picking mining stocks so that you understand that you need to really focus on risk in any investment, whether it be bullion or mining stocks or whatever the case may be, ETFs, that kind of thing around the gold and silver space and the overall commodity space. You need to understand the risks of each investment. And we did a really good, strong risk piece at the end of that part one for you, specific to the miners. Now, at the end of this whole presentation, we're going to go back to risk, but we're going to look at it not only for the miners, but from a portfolio perspective of all different types of gold investments. And I'm just going to walk you through that. That'll be a single slide of bullet points on the screen, but I'm going to walk through each bullet point and give you a nice explanation of each just to cap that off risk management and understanding what you're getting into is critically important before you do anything. Part two of this series covered pricing, derivatives, and manipulation. And by pricing, I mean spot pricing. In this presentation, I'm going to super briefly review spot pricing, and I'm going to tell you the difference between spot pricing of on the industrial markets for gold and silver and how that eventually leads to retail prices and what can affect retail prices. And I've got a really good set of charts for you looking at the retail prices of different products in the market, end products, the bullion pieces and the sovereign coins, so that you understand the difference between that and the spot prices everybody looks at every day. We also covered, we'll cover spot prices in the US and the UK. We'll very briefly review that, but if you're really interested in how spot prices are determined, go back to part two where we discuss it in much more detail. It's critical that you understand how spot prices work. It's one of the biggest frustration points of bullion investors is why do spot prices not reflect my perceived reality of the precious metals market? And I go in detail about why that is. And it has to do with paper derivatives, the next point on the screen, and regulation of the markets and manipulation, how people move that around. All of those pieces go into determining prices. And so we talk about manipulation and regulation there using not only my research, but research from people who worked at the CFTC in a couple of roles, investigations and enforcement. And one was in enforcement, but was also a lawyer by trade and been cited by the Supreme Court and many other resources, and how regulation and manipulation works. And so a couple of really very experienced and credible resources there other than myself on regulatory environment and manipulation that you need to know when getting involved in any commodity or precious metals investment. All right. On to this presentation, part three, we're going to go over four basic areas. We're going to talk about fundamentals, and that's long-term factors that can affect metal prices. Now, prices on a daily, sort of monthly basis, as you can see in part two, technical analysis, which we'll go over, are more dependent on market actors and technical trading. The fundamentals affect the overall medium to long-term prices of precious metals and trends. So we're going to start there. And we're going to do that again in charts, and then we're going to roll over in technical analysis, and we're going to do charts. Now, a word on technical analysis. Some very popular gold market commentators, specifically those that promote the bullion, which I've got no problem with, but they'll say that technical analysis should or does not have anything to do with it, and that is patently false. Technical analysis has a lot to do with it, and we covered a lot of that in part two, and we'll continue to cover that in part three as well. And determining the spot prices is just a fact of life, and it frustrates a lot of people. But I will tell you, all markets have technical factors by the market traders and market movers or market makers that participate in that market. I'll also tell you that there are four banks that trade most of the derivatives in the United States, not only commodities derivatives, but all derivatives over all markets. And so there is some concentrated power in some of these derivative markets that determine prices. Same thing for the mortgage market, same thing for interest swaps and derivatives, same thing for the stock market and bond market. And it's just a factor of the way it is today. And we have to recognize that. We can't ignore it. While I would love for everything just to be on the fundamentals and just to be on the physical trade, the fact of the matter, it's not. Fundamentals do determine long-term price and direction, but the short to medium term is often determined by the market players and technical factors in the derivative trades. All right, on to part three, retail prices. We're going to talk to you about the difference between spot and retail, and we have a nice slide on that. And we're going to talk about how some of the products in the US, popular products, are priced. And we've got some historical data for you from a good friend of mine who is in fintech, who developed this really cool free website. Now, he did this not only for gold and silver on his website, he talks about other asset classes, but he did a really good gold silver section, and we'll get in a little bit more to that, which I consulted on a little bit of, by the way, when he asked me. And so I love his site, and we're going to get you some charts and graphs and show you where you can go get that information for yourself for free, just simply by going over to his website. And then the last part's risk management. Again, single slide on risk management, but I'm going to walk through each of the bullet points so it'll be a substantive piece, and helping you look at the risk profile of investing or putting money into any sector of this market that we've covered in the masterclass, so that you have that knowledge before you push a button or send a check, as the case may be. That's very important to exercise risk management anywhere in your portfolio. And sometimes risk management is going and talking to an expert, not listening to a guy like me, but going and talking to an expert that you trust. Also, your accountant for like tax issues and also maybe your lawyer for any legalities in terms of whether you can get into it. Some things may, stages of investment may require you to be an accredited investor. You need to learn those rules if you're going to do that, especially if you're getting in on the early stages of private investment on the equity space. And sometimes it's just good to know the legalities of how ownership of that can affect your taxes and your positioning in terms of your overall finances. So I fully recommend reaching out to your local, not only market experts, but accounting and legal resources as well. Just a little bit recommendation on that in terms of risk management portfolio, not just knowing the asset class, but understanding how the asset class fits into your long-term investment picture and getting the right information from those independent individuals as well to help you navigate that. So you're not doing it all by yourself. But this will help get you educated on the basics so that you can think about taking next step if you want to. All right, on to gold is money. This is fundamental analysis. In fundamental analysis, we're going to talk about gold against the dollar. We're going to talk about gold against inflation and other asset classes. And these are many of the fundamentals people look at when they're pricing gold and silver. And I'll talk about the differences between gold and silver as we go through, which one is a little bit more of a monetary asset, which one had a monetary history, but is more moving to an industrial asset, and differences in how gold and silver are traded, and similarities and how they're traded. We'll get into that. First of all, gold and silver have been money for 5,000 years. It is natural money. Many ancient civilizations have used it. We used it as money up until 1913, and then we used the dollar, but we pegged the dollar to gold and in the central banking model. Now, in the last 175 years or so, the Western world the Western world, now all of the world, has moved to primarily a central banking model in which we have some sort of fiat paper currency that's traded against each other in like a basket, like the DXY. And it's more indicative of currency and economic flows. I'm not going to go into detail on that. It's just to point out that we're no longer in the gold as money era or the subsequent gold standard era, but we may be going back to that in a way, and I'll talk about the central banks next in the next point. Despite all this, though, even though we're in that era, gold has maintained its purchasing power over time. It's followed inflation for the most part, CPI inflation at least, maybe not real inflation. That's a subject for another video for the most part, but it's actually lately exploded past that. We'll get into the charts. But gold over time in particular, even more so than silver, and silver does this to an extent, but the industrialization of silver have changed that a little bit. But gold specifically does maintain purchasing power over centuries and centuries and centuries, why it is the ultimate store of value and is used by central banks. In the next point, with Basel III regulations coming out of Brussels, the central banks have made the gold equivalent risk-wise to currency and bank credit as a high-quality liquid asset. So it sits at the top of the riskless assets or almost riskless assets that a central bank will use to capitalize its balance sheet. This came about in the last few years. Now, the Basel standards really were talked about in 2014. I think the first recommendations or requirements were issued in 2014. Banks have been trying to recapitalize according to these new standards for a long period of time. They're not really quite there, and they're already talking about Basel IV standards, like Basel III plus Basel IV. But even though the standards have been out, it's taken a long time to get there because we live in a fiat debt world and they have to recapitalize. And that can be very difficult to do, to unwind all of that fiat and derivative mess. And so while they're heading toward that Basel III standard, they haven't quite got there in terms of reserve ratios and things. And so they tried to soften a little bit the reserve ratios. But just know that gold has become a really big component in terms of global financial stability by the central banks that issue fiat currency. And that right there tells you that gold is the ultimate safe haven, because they're using gold to what? Support what? The central bank, which supports what? Ultimately, the debt and the fiat currency of that country. Central banks have been buying more gold since 2011 than at any time in history. And gold will capitalize the new digital banking system, but will not be included in daily retail transactions. Gold will be considered the money of kings once again, or the rulers of the money, the central banks and the governments, while they're going to issue two tiers of either CBDCs or stable coins, depending on what country you're looking at. Now that system is being developed. A lot of it is operational. It's not all been settled on. We're still using fiat versions of currency with traditional debt. And again, that's a subject for another video. But in any case, gold is going to be at the center of the new financial system, and it's going to be a part of the reset of prices and currency valuations, which is going to affect the purchasing power of entire nations and the trade of commodities and goods as well. So it's going to be very fascinating. If you're into monetary history and all that kind of geeky stuff like I am, the next few years are going to be absolutely fascinating as we move into an entirely new currency regime than we've ever been in before. You know how we moved from like the commodity money era to the fiat money era, and we're moving from paper fiat money into some sort of digital fiat money. But the one key the entire time that's been a part of that has been gold. And it's still going to be a key going into the future. And that tells you how valuable gold is. Why you may just want to consider having some, up to you. Grassroots effort in the U.S. to establish gold as legal tender through state legislation is accelerating, but governments want a digital system with gold as an official underpinning. I personally think that there's going to be a battle in the United States between states and people's right in the federal level, between commodity money and between fiat money and the new digital currencies. But that also is a subject for another video, but I wanted to throw that in there as well, just as a point in case you haven't considered it or haven't heard it. All right, now we're going to talk about gold and energy. It was typical that when you have these far-flung gold mines all over the place, you can't run power lines to it, so you run a lot of diesel fuel and diesel trucks trucking it out. So oil and diesel prices, diesel as a part of the overall oil distillates or stuff that comes out of oil. I believe I saw a video yesterday that diesel fuel is about 30% of the average barrel of oil. So oil prices and diesel prices used to be a big factor in determining gold price because it was a cost input. But you can see on the chart is about 2024, gold completely separated on the right-hand side. And it's exploded past oil prices, while oil prices have fallen. Now, some people say that oil is undervalued, and that may be. It happens from time to time. Again, a lot of paper derivative trades on oil as well and futures trades, but oil will probably rebalance somewhat higher. But I think what you're seeing is the deflationary impact of the world economy and how oil is demanded less. Certainly some new supplies have been found, but overall oil over the last 50 years has gotten a little bit harder to find, and the finds have been a little bit smaller, so the overall cost per barrel has gone up. And I think the line that you see down, dating back to 2024, is more an indication of the deflating world economy and why gold is exploding to the upside, because gold is the ultimate safe haven asset. And if we're going to go into a global recession, gold price is going to continue to rise. And if we're going to have fiat currency failures, gold's going to continue to rise. And so now I would argue that oil is not the primary determinant of gold price, or one of the primary determinant of gold prices. Energy isn't. Gold is now repricing everything else. Everything's being priced in gold via versus the dollar. The dollar used to be the world reserve currency. This year, it was October or November. I can't remember what. No, it's September or October. It might have been October. Late summer, early fall, in which the dollar as a percentage of global foreign held currency reserves, euro dollar accounts is what they're called, fell below 50% for the first time in forever. And so from a technical standpoint, gold is not the reserve currency of the world anymore because it's used in less than 50% of foreign transactions, even though for all intent, nominally or on its face is still reserve currency. It's being used less and less. Now you have competing currencies, and now gold contracts are coming out. And as people de-dollarize out of the US dollar fiat system, and this era of fiat money ends, this stage of the fiat money era, and we move more to the digital side, everything's going to be priced in gold. When the reset comes, everything's going to be priced in gold. And that dates back to Basel III, and the central bank's capitalizing on what? Gold. Okay, makes sense. And that's basically what this chart says. And we'll go into more other types of fundamental analysis that people use when they're talking about gold. So this is, okay, commodities. So we're looking at gold against the S&P Commodities Index, the GSCI. And you can see then about 2022, almost 2023, the commodities index started to plummet again. Worldwide deflation and demand for commodities has been falling the last year and a half or so, almost 2 years. Well, I'd say about 2 years. And then gold has been separating. Why? Because risk in the system is going up. So gold now is not viewed as a commodity in its real sense. It's viewed as the ultimate safe haven or ultimate lowest value, not lowest value, but lowest tier of money, highest value money. Again, Basel III, high quality liquid asset. Gold is separating from energy. Gold is separating from the rest of the commodities complex because it's taking on its traditional role as true commodity money and the commodity money of highest value. And we'll compare it to the dollar as well here in a minute, where you can see that gold is valued more than the dollar worldwide. But I found this interesting when you compare it to the overall commodities complex. So gold and silver can separate from the overall commodities complex when risk rises in the system, and gold and silver return to its historical role of being money. Now, silver is a bit different. We'll get into silver a little bit later in the presentation, but it still has a monetary component, and we'll talk about that and how it's a little bit different than gold and silver, but silver still has that monetary component, and how that can be the most explosive move in a silver bull market is when it separates from just being one of the world's critical commodities used in everything to actually also being money, and how that value absolutely explodes. And we'll get into the gold and silver ratio a little bit further along as another way to analyze gold and silver prices relative to each other in like a bimetallic sort of natural money standard, if you will. All right, this is gold versus 10-year treasuries, the IEF. Actually, it's 7 to 10-year treasuries. So I took 7 to 10-year because that's like the middle version of treasuries. Now, the 10-year is used eventually as the benchmark for interest rates in the United States. It's when everybody kind of looks at it and says, okay, this is the benchmark interest rate. And this interest rate can affect things like mortgage and auto loans eventually as it trickles throughout the system. Now, there's certainly other issuances of treasury. There's short-term like TIPS, and there's 2 years and 30 years. And now they're talking about a 50-year perpetual bond in which you may never have to pay back the principal, at least during anyone's lifetime owning that. But the 10-year pretty much is the benchmark. So I wanted to show you that since 2000, basically since the tech crisis, while bonds have had, a decent return, as interest rates have started to rise, that returns has started to erode. And you can see that starting in 2022. As interest rates started to rise on the U.S. treasuries, the midterm treasuries, the valuation of the face value of those bonds have fell because the interest rate is inversely proportional to the face value. And I'm not going to explain that in this video, but that's just how bonds work. And gold really separated right after about 2003, 2004, actually the beginning of 2004. Gold valuations started to supersede bonds. And that was an early indication after the tech crisis that people were valuing gold more than the debt of the land. Now, treasuries are used as currency. They're debt, but debt in a fiat money system and the actual currency are flip sides of the same coin. One begets the other. And so really this is a sort of stealth indication of dollar strength because the treasuries are a way in which people invest in the debt. And that is a measure of the overall economic and currency health of a country like the United States. And gold has been separating now for 21 years, indicating that we have increased risk in the system, in the economy, which is reflected in debt and currencies, and that gold has been absorbing that risk for now 21 years. And we'll see as we get further in how gold's been one of the best producing assets in terms of return, just nominal return, and even inflation adjusted return since 2000, since the tech crisis. As a matter of fact, on the very next chart, I've graphed gold since 2000 versus the S&P and the Dow Jones. The S&P is the green line here, and the Dow Jones is the pinkish line. The Dow Jones is up 357%. The S&P is up 426% since about 2000, while gold is up 1,246%. So it's a multiple of the stock markets. Now, if you go back into the 90s, the stocks beat it because the stocks were so beaten down, after the 70s and 80s that they rose a lot more. But really, if in the last 25 years, of investment, gold has straight beat them. And we're not talking about lease rates on gold. We're just talking about the spot price. And you can see here on the chart on the right-hand side, I graphed out the Fibonacci's. And if you follow my channel, I talk about Fibonacci's a lot. And all it is, and I learned this first when I got into Forex a long time ago and got my Series 3, Fibonacci is just a mathematical measure of certain key indicator levels of evaluation of something like a stock or a commodity or something like that. And traders often use that to trade to. So often as you bump up against the next or bump down against the next Fibonacci level, it becomes a resistance or a support line in terms of the valuation of that asset. And without getting the mathematics of it, it's just psychological. And that this is a fundamental analysis of gold versus the stock markets, but the Fibonacci is a technical indicator on how they're traded on the derivative markets. But we'll get into more of that a little bit later, but gold has done quite well against the stock markets, reflecting that gold is seeing increased risk in the system. And that even though we've had a lot of money pumping that eventually leads its way to stocks as money increases, it seeks return. So it goes in the stock market because the stock market tends to have boom or bust potential and high return potential. And if you look at the people with 401ks and pensions, they're dumping a ton of money in the stock markets. Even though all that money is moving in the stock markets, gold has been measuring increased risk since 2000. You can clearly see that in this chart. So if you own stocks and you think that you're doing the best thing by owning stocks the last 25 years, if you simply bought some gold, let it sit there, you would have beat it with much less risk. And that shocks a lot of people when they see this chart, but it is absolutely 100% true. All right, now on to inflation and the DXY. Now, inflation is a measure of prices in the economy. Really, inflation in its most basic sense, and according to Austrian economists, is the measure of money in supply in the economy and not prices, but eventually affects prices because if you look at how much money is issued, if that money is more than the gross domestic product or the overall product in the economy, then you have more money chasing faster money production, chasing slower goods production. It means prices are going to have to rise. So you balance that equation, supply and demand. Okay, and prices will balance somewhere the amount of money issued against the amount of product. And if money has been increasing more than product or production, from services or goods, then overall prices are going to rise in the economy. It's very easy to understand that. Even basic Keynesian economics does explain this. You don't have to be an Austrian economist. And so when you look at the overall CPI inflation rates graphed as from the Bureau of Labor Statistics, USIRYY, the purple line, you've seen about a 20% increase since the mid 90s in prices. Now it's been much higher than that in real inflation, but this is just an inflation measure to let you know that even though the money supply has been increasing, the valuation of gold has been increasing more. One, because there was pent-up demand dating back to 1971 when we printed too many dollars to gold and we had to come off the gold standard, Nixon, but also that overall the risk has been rising in the system. And when you look at the DXY, which is the dollar against a basket of other popular world currencies, about four or five of them, I believe now, the DXY had strengthened, but it's starting to fade out a bit, meaning the dollar had strengthened relative to other world currencies, but it's starting to fade as de-dollarization occurs. And that was really the inflection point of when the DXY just flatlined and started kind of moving down, is when gold absolutely exploded. And that started in 2024. And you can see that gold had this cup and handle pattern, which I'll get into a little bit more later. And then you had the handle, which is a cool up period, and then explosion upward. By the way, no matter what chart you're looking at, whether it's stocks or anything else, if you see a long-term cup and handle formation, especially like a 10, 12-year one like this is usually an indication of an explosion in prices upward. It's a very popular technical formation that speaks to the fundamentals of a market, but it's a technical analysis. And you can go read up on cup and handle on Investopedia if you want. They have a really good article there on it. All right, gold to silver. So it's interesting to note that over the last 30 years, the gold and silver have had almost the same returns, and people will be shocked by that because silver goes up much more during a recession. You can see that in the chart down here at the bottom from 2009 to 2011, when gold and silver prices reacted to the 2008-9 mortgage crash and Great Recession and exploded upward. And then silver went up more, but came down more. It's more volatile. A lot of that has to do because it's an industrial metal. In addition to being a money. But you can see when silver is valued as money and it's more affordable per ounce than gold, people get into it, and silver has a higher price, a higher explosion to the upside than gold does. But overall, all things considered, about the last 30 years, silver's had 881% increase and gold 962. So they're not that far off. It's just if you want more stability in those price movements, gold, if you want to take advantage of the volatility and you want to speculate a little bit more, you can get into silver. And we're getting the gold silver ratio on a historical basis, a much longer historical basis here in a moment, dating back to 75. But right now I wanted to look at a gold technical analysis. And now I'm going to get into a little bit more technical analysis on gold. And I'm going to show you a couple things. So at the bottom, there's RSI, which is a relative strength indicator. It is a technical indicator that looks at the amount of trade, the price movements to the amount of trade in an algorithm that tells you, by and large, whether from a technical perspective, not physical trade of gold and silver across the world, but from a technical derivative market pricing, spot pricing measure, whether or not this thing's heated up too fast or too slow. And a lot of times you can say it's overbought or oversold. If it's oversold, prices usually come down. That's an indication. If it's overbought, prices come down. If it's oversold, prices go up. Now, a lot of people criticize it and say, you can't, be overbought on gold because look at the risk in the system. I'm not talking about the long-term price movements and the fundamentals. I'm now transitioning to technical analysis on the derivative pricing, which really has to do with short to medium-term spot price movements. Again, if you want to know in detail how spot price is calculated in both the OTC market and in the COMEX here in the US, the two markets that predominate the gold and silver spot market prices, go to presentation 2, where I have lots of studies on that from some PhDs and charts and things that explain exactly how that works. You just have to understand that derivative markets do the short to medium term pricing, and long-term price movements can be affected by other things. All right. Now, as we look at this, you have like a rising wedge formation or a flag formation, if you look. So it means higher highs and higher lows. You've got higher lows going up on the bottom, and on the top, you got higher highs. That usually means you're in a nice little bull market, and we have been in gold since 2000. Actually, there's been a longer-term bull market for the last 50 years since gold has been trading freely and not pegged to the dollar. The dollar's not pegged to gold, but I'm really just focused on the last 25 years. It's very illustrative. And you can also see here outlined in green these three squiggly lines on the gold. Here's a gold squiggly line, and then you have the green up, down, and there. That's the cup and handle formation. So you can see about 2011 when gold started to come down, it went basically into almost into dormancy for 5 years. And then 2016 started to pop back up and then rose all the way to 2020. through the pandemic and after the pandemic scare, where gold was pricing in risk and rose to that peak. Then it, as the pandemic scare began to ease in the economy and the economy started reopening, gold fell. That's the handle. So you have a cup, you have gold reaching a previous all-time high price, and then a cup formation forms where it goes down and then back up, signaling it's repricing risk in the system. But then it comes down a little bit, but it doesn't go all the way down. That's the handle. So you have the cup and the handle, right? And then once it gets to its handle stage, and then usually it's a sign it's going to go pop. And that's exactly what happened. And again, that started in 2024. So the last 2 years, gold has been really pounding higher, hitting consecutive new all-time highs. And that's indicating much higher risk in the system. And this was dating back to the Great Recession. That rise in price up to 2011 that started really back in 2000 since the tech crisis. So gold had pricing in 2 recessions. And then when the problems weren't resolved, you had that massive money printing and massive amount of debt issuance by the US and across the world in other currencies as well. That's caused gold to absorb all of that risk and to absorb a lot of that inflation and to pop higher. And we think that it's going to be more because I don't think they're done printing. The Fed right now is talking about easing again because it looks like we're heading into recessionary conditions. And they're trying to manage that by going from quantitative tightening, which is where they suck up liquidity in the system and raise interest rates, to easing, where they may issue some liquidity and lower interest rates to facilitate more easy money. In the short term, that could cause gold to pause a bit, which it has, because people are waiting on the Fed to make decisions. And the government shutdowns are also not producing all the economic data. So we're in an uncertainty stage here as we end 2025, as I'm doing this presentation in late November 2025, right before Thanksgiving Day. On the, I believe today, the 27th. I'm sorry, 26th. Thanksgiving Day is 27th. So, but as we go into 2026, a lot of people come out, Saxo Bank, JP Morgan, Bank of America, TD Securities, a lot of the investment houses are saying Goldman Sachs, very, very bullish on gold in 2026. So we're going through a temporary sort of uncertainty consolidation pattern. If you look at gold on another chart, just over the last few years, it's a consolidation pattern where we're saying that gold is coiling. It's absorbing all this risk and uncertainty, but it looks like the market wants to take it higher. A lot of the financial houses are jumping into gold saying we think it's going to go higher. That's a little bit of a technical analysis for you. Let's go to technical analysis for silver. So I've got silver graphed out to the 1970s. It also has a cup and handle pattern. It's a bit of a different cup and handle. It's an elongated cup. So it's really high, spike, come down like this, and then spike. And that is silver in a nutshell. Gold will move in smaller, more smooth, not quite sine wave, but sort of that smoother, curvy sort of movements over time because it's the ultimate safe haven asset. And while about 28 to 30% of gold is used in things like jewelry and main boards as a industrial product, most of it is monetary demand by like central banks, financial houses, people, stackers, if you will. Silver's different. Silver really dating about 30 or 40 years ago became, after industrialization and into the information technology age, advent of the internet, started being used in a lot of things, and so it became industrialized. And we're actually running mining deficits every year where there's not enough mine output to accommodate the physical output. And so above ground stocks across the world are starting to drain. And that's caused silver to spike recently. So silver sort of flatlined as it's a commodity, it's a commodity, it's a commodity. Oops, the commodity is running a shortage. And then monetary demand comes in, it's going to go pop. So it's a little bit different of a cup and handle, but you can see a clear cup and handle. And since 2001, the tech crisis, much like gold, you can see that silver has been in a rising formation, lower lows and higher highs opening up. So you've got a cup and handle leading into right past that handle, a rising wedge formation, which is both of those back to back are very bullish on a technical indicator perspective. So certainly we expect the derivative prices on silver to continue to rise. That doesn't mean there won't be periods of rest or even some pullbacks as people rebalance their technical spot price derivative trades, not physical. Remember, this is technical on spot price. Refer to presentation 2 for a detailed explanation of how that's calculated. But that's how technical analysis is used. And so if you're in the market and you're seeing, and you don't understand all this technical analysis and derivatives and how industrial prices are determined, you're going to your coin dealer and you're like, spot price doesn't reflect reality. But what that does is if you're smart, you wait for the prices to come down. And if you think they're going to go up, you get in when they're cheaper. So these technical movements, these short to medium term technical movements, can provide buying opportunities for you if you want to get into the physical. If you believe the long-term fundamentals, which we covered in the first part of the presentation, are bullish for gold and silver, and I certainly do, based on the data provided throughout the series. All right, moving on to the gold and silver ratio. If you look at the amount of gold and silver mined, it's something like between 9 to 1 and 12 to 1 more ounces of silver to gold are mined. And that dates back at one point it was 15 to 1. You can talk about the history of it, but it's somewhere in those sort of lower single digits to up to about 15, 16 ounces, double digits. More silver than gold. But because silver is used much more than gold and it's thrown away in landfills and stuff, silver doesn't get recycled quite as much. There's not as much above ground silver as a percentage of the overall mining kept. So that's caused this dynamic of people thinking silver to be way undervalued because how are you going to go get it? You're going to dig it out of all the iPhones and dental, you know, toothpicks and all that kind of stuff that silver is used in, all the fields that it's used in. It's used in a missile, it gets blown up, so it gets vaporized. So a lot of silver is hard to recover. And so some people think long term that silver should, go up in price much more than gold. And, if you go back to this chart, it does. If you go look at the gold and silver ratio dating back to like the mid 90s, just from that 30-year time frame, silver gets more explosive like during the Great Recession, 2009, 2011. And it gets really explosive when monetary demand comes back in. And so that can change its gold and silver ratio. But it's interesting to go back to 1975. And by the way, this chart and many of the subsequent charts I'm going to show you are from Tony Trevisian, who is a fintech guy who understands both coding and technical development as well as markets, fintech, financial and technology. And he put together this website, Alt Analytics. He put together valuations on a lot of the market, including stocks and dollars and stuff like that. And he's got a whole section on gold and silver. And we're going to look a little bit at COMEX stuff, and then we're going to look at retail bullion. It's really cool. And he consulted with me a little bit on the retail side to say, how should I present these charts? And I consulted with him, and I've been using this as a resource ever since. And he pulls the prices off the internet, puts them in nice charts. This is just gold and silver, just spot price. Before, we're not into retail yet, just spot pricing, industrial pricing on the market. And he shows you since 1975 how that gold silver ratio has risen, meaning gold has risen more than silver proportionately. So you can say gold on top silver. And that's why people think that silver will catch up and pass gold in terms of percentage returns. Maybe not in terms of end price, because silver's more abundant, but in terms of percentage terms, because silver's so undervalued because of that increased industrial demand. But to really get that pop, you either need the final physical silver squeeze shortages to occur in real terms, but also that monetary demand to get silver to do that final pop. So some people will invest in silver, even though it's more speculative, a little bit more risky, because they think the upside is much, much more in the future. I do too, but it's going to take some time for that to play out. But that's one of the sort of technical and fundamental valuations that people look at, whether to buy more gold, more silver, or rotate their gold and silver positions within their existing portfolio, or to rebalance by adding more gold and or silver, and how much, in terms of following what they think is going to be the end prices for gold and silver relative to each other as like a bimetallic long-term safety play or long-term value play as the rest of these asset classes experience more risk and we get more into like monetary reset and worldwide deflation and stock and bond market issues and currency issues and stuff like that. So just thought I would throw that out there for you. All right, now section 3, we're going to talk about retail versus spot. So this is a very interesting piece to talk about because I talked in section or part 2 of this series a lot about spot. Again, if you really want to understand spot, I touched on it lightly in this presentation, but very heavily in the last presentation. It's important to understand that because you're not going to understand price movements when compared with fundamentals in your head. Oh, there's too much risk. There's too much risk. Why is spot doing this? Because there are technical derivative trades that affect the short to medium term prices, even though the long-term trend is more driven by fundamentals. It's been proven by studies, which I have in section 2, and also the regulatory environment and the ability of market makers to push it around and concentration of the largest 4 derivative traders, those types of things. All those considerations go into spot prices, not only of gold and silver, but the commodities complex, everything else. The 1,000 products traded in the US that are commodities based, from energy to food to metals to everything. So go again, look at part 2, but I'm going to do a super short recap for you. So spot prices are the derivative paper market or industrial markets, the US COMEX and the UK over the counter. Now, that is shifting east to where Dubai and India and Russia and China are starting to have more of a pull on the global gold and silver price. I certainly think that the Chinese and Russians and probably everybody, honestly, in the East or elsewhere from the West, if you will, the global South, however you want to look at it, the emerging and number two, three, and emerging economies are playing gold and silver as they build their economies. And that's having a pull-on effect on the US and UK markets, where US and UK aren't completely the ones determining spot price, but still they are the two dominant markets. And there are differences between those two markets. And there's a whole study by two PhDs on presentation two as well. So spot prices, they do not go up in tandem with physical supply and demand on a short-term basis. That's the market makers, proven over and over in part two. And anybody wants to argue with me, go watch part two. Long-term physical demand matters, but it really takes years to move the chart unless you have like a black swan event, meaning Great Recession crash, gold and silver technical will go straight up because people are playing that technical price risk from an immediate black swan or unexpected event, if you will. Although on a general basis, in between those types of big currency and economic events, there is no spot price correlation to those worldwide events, as proved in a study in presentation two. Although the long term it does, the short term it does not. That's why if you're price watching on a daily basis, you're just going to get frustrated. So I don't recommend it. Understand the longer term trends is a much better way to play if you want to get into the bullion market. All right. Gold since 2000 has mostly followed CPI inflation until recent years, 2024, when it went pop, and it was no longer driven by just dollar inflation, price inflation in the US. It's now pricing in coming deflationary risk of a recession and the breakup of the bond, stock, and currency markets that is coming during the financial reset sort of language that you've been hearing on the internet for the last few years, essentially since 2000, 2008, 2011, those two recessions, and also the pandemic. Talks about the reset has become much more popular in financial circles since then. If you don't know what the global reset or the currency reset is, I recommend my channel, or Lynette Zhang is fantastic on YouTube at covering this. The Kinesis channel has been fantastic. Capital Cause and with Danny, Dunnigan's Liberty and Finance. Lots of popular channels talking about it, and lots of literature from financial houses, PhDs. I mean, a lot of academic literature on that as well. Look at the Kenneth Rogoff Reinhardt study on debt levels and the point of no return. Just some keywords to look for. Harvard and Yale researchers, I believe, that did a big study on that after the last recession, 2008, 2011. That's also a popular piece. And then the fourth turning piece and the great taking and those types of pieces, which talk about cycle rotations. North Star Bad Charts, which talks about cycle rotations and shows it to you in charts between different asset classes. It's really talking about how the world is moving from this fiat bubble era into more of a commodity era, and it's going to go through deflation first. Anyway, much different presentation. We'll get into that in a different presentation. All right, last point here on spot prices. Silver is more volatile than gold on both the up and the downside. We saw on the charts. Although over time, the last 25 years, they've been actually pretty close together over time. In shorter period of time, silver's like this, you know, it's the little yappy dog, and then gold is much more smooth. It's, you know, the older, more stable dog with the yappy dog. Silver, you know, silver will follow gold, but it's yapping the whole way. It's more like this the whole way. It's kind of a good way to describe it. Physical industrial demand levels play a stronger role in silver's prices because it's been more commoditized as an industrial component, and it's been named a critical mineral by the US and several other countries because of recent shortages in mine production and because it's used in so many things. Silver now, in recent times, the last few decades, is not as much of inflation hedge as gold, as much as it is an industrial metal that spikes or moves around a lot when investors rotate into metals from other markets. And I just talked about that just a few seconds ago about how people are getting out of these other bubble asset markets and moving into gold and silver as they see worldwide economic and currency risk increase. All right, retail prices, those you'll pay at your dealer, whether online or you go to a store or however you get it. Those carry premiums on top of the spot price to account for the cost of refining, minting, wholesale distributing, and shipment to your dealer. The next 2 points I want you to pay attention to because most people do not understand this, but I'm going to demonstrate it in the charts and through anecdotal evidence of me being a dealer and buying for the last 16 years as well. Certain product types, a bullion, carry higher retail premiums than others, which is dependent on local supply and demand and national overall minting supply and demand. It's got two factors. It's really exciting. So you can't look at a Silver Eagle price on APMEX and a Silver Eagle price at your local dealer and expect them to be exactly the same. And this drives people nuts, but it is 100% true. The American market is very brand loyal. brand loyal in two instances: brand loyal to the specific bullion they're buying, and brand loyal to the outlet at which they're buying it from, the distributor. But they also like to enjoy as much diversity in product and distribution outlets to a certain extent. So they're brand loyal, but there's a little bit of flexibility in that along the way as well. But brand matters in the US. Everything from gold and silver to cars, to your laundry detergent, to clothes, to what TV show you watch, to everything. Brand, 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 brand is so important to Americans. We buy on brand. Why? Brand is a reflection of reputation, feelings of how that brand makes you feel about the product on top of the product. You may like gold and silver, but you really may like that distributor of gold and silver. Or you may really like clothes, but you like Nike versus Reebok. You really may like sportswear, but you like Under Armour more than whoever. We all have our preferences on brand as well as the end product that we're buying and the type of end product that we're buying. I want to make that point. Okay, so those last two bullet points are very important that a lot of people know intuitively, but it frustrates them when they actually see it occur in the real world. But it's important to know that not all retail prices for the same product is going to be the same everywhere. And certain people would like certain types of bullion better than others. All right, we're going to show that in the charts. All right, here's a super short recap on spot prices. I want to show this chart at Tony's website. And, on these charts I pull from Tony's website, I give you the link down there. It's all analytics, right? Just go there. And if you want a full examination of spot prices on the COMEX and LBC part 2, I've said this many times in this presentation, it goes in more detail. But you can see that the difference between the London market and the American market between gold spot prices has increased since about 2003, 2004. So there are arbitrage or the ability to play different prices on gold and silver dating back the last 21 years. And that spiked recently because a lot of it has to do with local supply. And the fact that London OCC's market is an over-the-counter derivative trade and the COMEX market is more of a futures and options. And so there are different models. And there's also different local demand profiles. And there's differences in types of contracts and the way that companies will position. And so that's led to an ever-increasing amount of differences in prices. And there have been times in which prices are so different that metal's been flown from London to COMEX to support that trade. There is some physical trade, and though it's about 99.5% derivative trade, there's physical in there as a percentage of about 0.5% usually on a daily trade chart of physical movement. And so there's been bars from London to the US, and now silver bars went from the US back to London. So when prices are different in different jurisdictions, spot prices, not retail, that causes metal movement on the industrial level. Okay, it's very interesting. Now, getting into retail prices, here are gold premiums by weight. These are gold products, and you can see that we have prices from a couple of different manufacturers, Monex and Bullion Star, graphed over time, the last 13 years. The red one is American Eagle, 1 ounces. And then you've got 10-ounce gold bar stock in blue, and then orange is the Canadian Maple 1 ounce. And then the 1 kilo bar, which is more popular over in that neck of the woods across the pond than the 10-ounce bar here in the US, and or gold 400 ounce. And you can see the different premiums. By and large, the 1 ounce sovereign coins, American Eagle and Canadian Maple Leafs, have higher premiums than bar stock. And you'll also notice on this chart that the smaller the product, the higher the premium. Because if you think about the minting cost is relatively the same to make a bar and a thing, not exactly the same in a coin, but there's machines involved. And so where you're doing many smaller ounces, the amount of cost to print that smaller coin versus a bigger one with a lot more ounces, it's more expensive per ounce. And so that partly goes into why the smaller issuance, the smaller you get, the higher premium. If you go to sub 1 ounce and get like 1/10 ounce gold, the percentage of premium you pay, the minting cost on that 1/10 ounce as a percentage above spot is going to be higher than on a 1 ounce coin, which is higher than on a 10-ounce bar, which is higher than on a kilo bar, which is higher than on a 400-ounce bar. So size matter and product type, sovereign versus private mint, sovereign, of the land mint versus these private commercial mints, there's also a premium there. That's what this chart illustrates across a couple of popular issuances of gold. Now we're getting into an even better chart, and it's a busier chart, but black line spot price, and that just basically says as gold price goes up. And you can see as gold price goes up, you still have different premium rates. But what I want you to see is You've got gold maples in gold. You've got gold eagle ounces, the most popular coin of the land, in yellow. The green one is gold buffalo, which you'll see starting in 2022. The pink is gold bar ounces, 400-ounce bar. The blue is gold bar ounces, 32 ounce, and the gold bar ounces, 3-ounce bars in orange, and then a green 1 ounce. And you can see that gold, and I'll get further into detail as to some of these specific. I'm going to go into gold American Eagles, gold maple leafs, and just bars in general. Okay, just like 1-ounce bars. I'm not going to go into all these subproducts, but you can see that the most popular coins by premium are always American Eagles, second Canadian maple leafs, two sovereign coins, 1 and 2 in terms of premium demand. And then you get into like the bar issuances. Why? Because more people issue bars and there's less supply of Eagles and maples. Plus, people will go to Eagles and maples first when they're doing a portfolio of physical investment before they go into like private mint or generic coins and bars, regardless of the size. That's just the way the American market's always been. I expect it to be that way pretty much for the next 100 years, probably, because people will buy the sovereign coin first, and those are somewhat limited in the amount they produce. And we can get into why that is a different presentation. But then the bars, which are more prevalent, more issuers, and in bigger sizes, tends to reduce that premium, both from a minting cost and a demand cost, because there's more available, if that makes sense. And so the demand per unit is higher on the sovereign coins than the demand per unit on the bars. I hope that's an easy way to kind of encapsulate all that stuff I just said. And this chart illustrates it historically. It's been this way dating back to 2013, 2014, but it's really always been that way since I've been on the market, 2009. And I'm told, from the older market participants that it's been that way for the longest time, especially in, I think mid-80 was at 85 that the American Silver Eagles came out. That's always been true. All right, now here's gold eagle only, American gold eagle only. You can see that there was a spike right after the pandemic, and you can see a spike in gold spot prices after the tech crisis in 2000, the 2008 to or 2009 to 2000, well, 2008 to 2009 Great Recession, the 2020, 2021 pandemic. You'll see gold prices, spot prices rise, but as a function of demand of a particular product, the gold American Eagle ounces rise the most. They rose 20% on a gold product. Okay, and you can see that clearly on the chart. They spiked up to 20%. And the cool thing about this chart on Tony's site is you also get to see all these different websites and how they priced it. I think Provident at one point rose the most, but you also saw Bullion Star get up there. You also saw all of them get up there. JM Bullion was up there, and JM Bullion is one of the cheapest providers. Well, they're cheaper middle, and then SD Bullion sometimes is one of the cheapest, but they all had higher premiums on the gold eagle ounces because of demand and because people wanted that product first before they got into all the other stuff. And there's also somewhat of a limit on supply on that as well from the US Mint. They only produce so many. Okay, makes sense. Now we're going to gold maples. That's a real Canadian mint. It is another sovereign coin that is extremely popular in the US, the second most popular by premium and by demand sovereign coin. Then you've got other things like the UK Britannia and the Austrian Philharmonic and all these other coins. But what rules the roost here in America, in the United States at least, is gold American Eagles first and then maples. Now, we also in the US Mint produced the gold buffalo, and that was also very popular. And the only difference between the buffalo and the American Eagle is the buffalo is newer, it's in recent years, and it's 999 pure. And the American Eagle is like, I think 92% has copper. And you say, why would I buy the 92% with copper? Well, because the copper hardens it and it holds up more, and it has a little bit more of a coppery tone to it, but there's still an ounce of gold. So if you put an American Eagle and a buffalo together, the buffalo is more gold colored and the American Eagle has a little bit more copper tone to it, but they both have an ounce. So the American Eagle is slightly more than an ounce, got an ounce of gold plus some copper. It just makes it more robust. But because a lot of other sovereign coins like the Maple Leaf and Austrian Philharmonic and stuff are 999% pure gold, the US Mint came out with the buffalo. So I'm not really graphing the buffalo here, but it's a popular product. But it is secondary to the American Eagle in terms of overall demand, increasing in popularity, but second in terms of demand. And I don't know the demand numbers for the American buffalo versus Canadian maple leaf. I would assume the buffalo's either surpassed it here in the US or is very close because it's an American product and it is 3/9. So in any case, not really super important, but just wanted to point that out in case you're thinking about what bullion to get into, understanding some of those product differences. All right. Again, gold maple ounces. Now, premium spiked same time after the pandemic and then started to come back down. You can see on the chart, but it only went up to 8 to 9%. Whereas we go back, the Eagles got up to 15 to 20%. The maples got up to about 6 to 8%, with one 9%. Is it Money Metals Exchange, MME, just for a short period of time. Now, why are all these lines not identical per outlet? Remember that each outlet well, I'll get into that at the end of the retail section. Each outlet has different factors in determining its own price, plus there's some local differences, which we'll get into. All right, these are the gold bar ounces. They went up to 5 to 7% spike after the pandemic. Again, it's not the 7 to 9% of the maples or the 15 to 20% of the eagles. So what has higher premium spikes and crashes after the premium spike comes down? American Eagles. What has the second highest premium spike and crash? The gold Maple Leafs. What has the third? Bar ounces. That has a function to do supply and demand at the same time for each product. As to when premiums will spike, when there is some sort of economic event which causes spot prices to spike in a short period of time. All right. Now we're getting to silver. Silver Eagles rose to 100% of premium right after the pandemic, and you can see that several providers had them 100%. As of recently, a few weeks ago, 3 or 4 weeks ago, the premiums were up on about $50 American Eagle silver. The premiums are like 12 to 13 bucks at APMEX. So you were seeing a 26% premium, certainly not 100%, but certainly higher than what we see in general from 2004 to 2005, although it was a short-term blip. So you don't see it pronounced on the chart. But there are periods of time when there are short-term supply shortages or short-term increases in demand that people go to American Eagles first. And if you can't immediately find them, it spikes that price. The silver Eagles, as long as the gold Eagles. But the silver price as a percentage of premium increase is 100% versus the gold Eagles 20. So gold always has a smaller percentage of premium over gold because it's more expensive to begin with. So the mint cost as a percentage of getting that coin out is cheaper than silver. And also, when gold goes to $4,000, you're not going to have a tripling all of a sudden of people wanting to buy American Eagles. They may go into silver because it's cheaper. The average person may not be able to afford an ounce of gold. They may go to silver instead. So that's also a factor in retail demand, is silver as a cheaper alternative to gold. And a lot of people are silver stackers only for that reason. Remember when I said the long-term price implications of silver could be much higher for those factors I talked about before, and also it's cheaper. So sometimes silver really spikes faster than gold because of those market dynamics, especially when you get into an established recession. And I expect that to be the case. Now, silver maple ounces, it went up to about 60% over at its peak, some of the biggest price increases from vendors, versus the Eagle 100%. So the maple, again, just like in gold, had a little bit less of a premium increase. And then you can see here the ounces were not nearly the same. I mean, it got up to about 16 to 18%. So there are more providers of the bars, and as a function of the price. So there are more providers and a little bit less upfront demand. You may actually at one point sell more bars than Eagles or Maples because they're more available. But for the most part, people are going to go Maples and Eagles first. And they're more price inelastic, meaning no matter what the price, people are going to buy them. And then bars is sort of that third place. And that's true of both gold and silver. So there are differences in the type of gold and silver that you get. And you can also see in the provider in their prices based upon some things, which we will talk about here in a minute. So section 3, conclusions on retail prices. Let's just wrap this up in a little nice bow and wrapper for you. Spot prices for gold and silver are almost never the price you pay for retail products. Differences in the US and UK industrial derivative spot market prices can affect retail prices because the UK's taken the lead in spot prices. The base of that cost and then adding retail premiums would be higher in the UK. So that's why similar products may be higher in the UK or higher in the US, because spot prices do have somewhat of an effect, although premiums, local delivery, local demand has a bigger effect. But spot prices can have a little bit of an effect in there. Premiums are added for different branded product types and are inclusive of refining, minting, and transportation costs. That's why you don't get them at spot, because the industrial bar is a big 400 or 1,000 ounce bar, depending on if you're getting gold or silver. Then they got chopped it up, melt it down, remint it into something, and then it goes from the mint to the wholesaler to the retail, typically, and sometimes multiple steps along the way. Well, there's a cost to do all that. There's insurance costs, or storage costs, there's trucking costs, fuel costs, minting, pressing costs, all sorts of costs that go into that. That's why it's hard to buy it at spot a lot of time. There is a retail premium, and it is a function of supply and demand, but also the cost inputs along the way. So you got your basic cost inputs, we'll do the base premiums, and then supply and demand can move that premium up and down off of that base. So that base is a percentage over spot, reflecting the supply chain. And then any addition to that is going to be supply and demand for that specific product based on market conditions and what is available. So retail prices are inclusive of many, many, many factors. And that's why it's hard to understand, if you don't understand all of this, why your retail prices move around on different products at different times. And it doesn't seem to make sense to you because you got to understand all these different pieces of it. Premiums are much higher in America for American sovereign coins, the Eagles and the Buffaloes, than Canadian sovereign coins, the Maple Leafs, or the stuff like the Bird series or other stuff they put out, and the private mint coins and bars after. Premiums vary widely between different retail outlets. Why? This occurs because each has different pricing power in the market. They can buy more or less. Okay. So if you buy a whole bunch more of something, your per profit at each item can come down and you can still make money. Smaller retail outlets may be harder to get those premiums down versus bigger ones. Each has different hedging prices. Some larger ones hedge on the market. They may go hedge on the COMEX and they may hedge with other products, whereas the smaller ones can't hedge. And so they have to keep their prices up a little bit more because they don't have insurance on it. So they could cover their inventory costs. What if spot price goes down? You may have to pull product from the shelf or you're going to sell it at a guaranteed loss. So there are different factors that go in terms of hedging, market power or buying power of each retail outlet, and each has a different consumer demand profile. Remember branding. Some people may like ATMEX. Some people may like Kinesis. Some people may like Bullion Star. Some people may like whoever to go get their stuff. So not only do you have an affinity for certain types of bullion, you have an affinity for the outlet that you go to because of their service level, their premiums, their turnaround time, your familiarity, how long they've been in the market, their pricing power, all goes into how consumers choose their outlet. So not all outlets will be exactly the same. That's why some variations in prices. And lastly, retail prices on popular gold and silver bullion products are not nationally set for reasons I've stated. They're local in nature and reflect differences in vendor strength and marketing power, as well as supply and demand profiles of the individual types of coins and bars themselves. All right, last session, risk management. We're about to end up on this bad boy. And this will be a risk management encapsulating the entire series. So parts 1, 2, and 3. I'm going to try to go through it quickly, and I'm just going to touch it at a high level. But because I want you to go to each presentation and understand how it works and the risk factors inherent within each stage of the market, from mining to final output of the retail product, and within each presentation piece, risk factors embedded within each one. So you really have to go through the whole series. But we're going to just try to do a quick little wrap-up encapsulation summary of risk across. So each product you invest in has a different risk profile, whether it's an equity, an ETF, or a bullion product, so on and so forth. Mining stocks are highly risky compared with bullion. They're also leveraged and can provide a much higher returns to a bull market in gold and silver than the metals, but they also can crash a lot more or completely go bankrupt. So that requires much more study on how they work and being very careful before you put a dime on them. Most smaller mining stocks will not perform well overall, but having only one that does really well can help your overall portfolio returns. So you don't have to hit on 10 of 10. You can hit on 2 or 3, and overall you made money, but you may crash out on 4, 5, 6, or 7, or you may break even on 2 or 3 and crash out on 4 or 5. That's the name of the game in mining stocks, and you really have to have the stomach for it. If you don't get in, okay? But if you want to take that leverage position like you would do it in like a tech stock or whatever, you may not be buying the iPhone. You may be buying Apple stock, right? Or you may not be buying Levi jeans. You may be buying the stock, of the manufacturer. The stock is a leverage investment to the product. The mining stocks are the same, leverage investment to the commodities they're outputting, but it comes with much higher risk, and it's more difficult to understand how they work. Remember the risk categories that I talked about in part 1 of the series for the miners, and do your own research first before putting a dime down on one. And if I had to make a recommendation, again, do your own research, consult your financial advisor and accountant. But if I had to do a recommendation in general, just for the general market as a research and education piece, I would say buy the bullion first and mining stock second. Just because as you get more sophisticated, then you can start getting into the higher leverage, higher risky assets like the equities. All right, bullion has a much more even risk profile. There's still risk, all sorts of risks, but it's much more even over time. Prices are affected in the long term by fundamentals. Short-term prices are set by the derivative markets, US COMEX and UK OTC, with now some pull on by the other Eastern markets that are starting to change that dynamic. And eventually I think we're going to have more regional market prices for gold and silver than we do now. And that's going to be a development over the next, I think, 5 to 10 years. But for right now, the US and the UK markets pretty much set spot prices for most of the world with some exceptions. All right. The traders on both markets determine which market is setting spot prices at any given time. It depends on if you're rotating to London or you're rotating back to New York. London, New York, London, New York. There's an interplay. There's an arbitrage. There's a pricing difference there that the traders play off. So sometimes it's the UK determining that. Sometimes it's the US. But that's determined by the market traders, not the long-term fundamentals of the market. The average person cannot trade these markets unless you're very wealthy and therefore ultimately has no reason to worry about them. So again, if you're price watching the spot prices and driving yourself nuts, why? Look at it over medium to long term, understand the fundamentals and technical aspects of charting and the fundamentals moving the commodities prices over the long term, and you'll have much less indigestion. That's just a nice recommendation for you. Don't try to day trade gold and silver. My goodness, please do not do that. You can get washed out and it may cause you to have gray hairs very, very early on in your life. Watching the charts too often leads to frustration because fundamentals do not drive short-term price movements, with certain exceptions like large-scale black swan events, that type of thing. The pandemic, big recessions, that big, huge bank failure, stuff like that can temporarily move it, those type of events. But the short-term price movements are almost always determined by market actors looking at their own portfolios and pricing gold and silver accordingly. All right. In the last 25 years, gold has outperformed inflation and most other popular asset classes. I showed you that on the charts in the fundamental section. Most people don't know this because financial media focus on the bubble dollar assets. So if you're just watching CNBC and you're just, reading Market Watch and no shade on those outlets, I follow them too because I have lots of helpful information. I appreciate those outlets for what they are, but they don't always cover gold the same as the others. Why? Because we're in the dollar era, not the gold era. And so gold is the exception asset. Okay, but you're seeing with the central bank buying, the increase in the gold price separating from the dollar, from inflation, from commodities, from the stock market, that we're now getting into a gold and silver bull market era. We're already in it for the last 25 years, but it's getting more recognition. And now more of the financial retail media is starting to cover it. It's not covered as consistently as dollar-based or dollar or derivative type assets like stocks, bonds, real estate, Forex, all that kind of stuff. And so this is the timing of why I'm putting this series out, because at the end of the day, I want you to understand that. Thank you guys for watching episode 3. We're going to stop the share and just kind of give you last final notes. This series was set up to educate you. This, it's a masterclass which covers everything in a good enough level so you get a foot or two deep. You may decide you want to deep dive into any particular area as an offshoot of watching this masterclass, or maybe you already had an interest, but at least just get you into it, get you started, shows you the factors that affect everything, the risk factors, how stuff works, so that you can start to get into different aspects of gold and silver if you want to invest, or if you just want to know how the darn thing works. This is a good class, but at the end of the day, there's much more to get into it. So just make sure that you're aware of risk. You're consulting financial advisors, disclaimer, disclaimer. You're also educating yourself, not only with my content, but looking at content from all various outlets, even going to academic content or reading a book. I mean, all sorts of ways that you can get it to make sure that you're prepared so you understand the fundamentals and the technicals and the risk factors and the cost benefit of each type of investment, and you understand how the market works, so you can begin to understand, well, I think gold or silver are going to go here, or I think the equities are going to go here, the ETFs are going to go here because, and you can start forming your own calculus, your own personal profile on where you think gold and silver is going, in addition to your investment risk profile and being aware of how much risk you want to take so that you can make intelligent decisions about how you want to participate in the market before you put a dime on any of it. And that's why the series exists. I want to thank you guys for participating in this series, for supporting me over the last 16 years of writing as an analyst, as a trader, and also as somebody that sells and promotes these products, for allowing me into your living rooms to absorb this information. This is all free. I hope it helps you. That's the whole purpose of the series, is to help and educate you so that you can trade this intelligently and understand it intelligently and speak about it intelligently, increase your chances of, one, dealing with all this inflation and all the risk that you have in your life. And maybe gold and silver helps you deal with inflation, and it's just a type of savings. Or maybe it's a way for you to invest in something other than these other assets if that's what you want to do and you want to make that a part of your portfolio. I did see a news article come out recently from one of the financial houses talking about moving from a 60-40 stock bond portfolio into a 60-20-20 stock bond and precious metals portfolio. I'm not recommending you do that, but now you're starting to see some of the big financial analysts move money out of bonds in particular. Think about bond risk and currency risk and economy risk, and maybe some stocks and moving it into precious metals. You can see the financial media starting to talk about risk and getting back into gold and silver, gold in particular being the ultimate risk hedge and ultimate safe haven asset, and silver coming along as well. Even though it's a little bit more industrial, it does have aspects of safety and of monetary value as well as we go through like a currency change, which we are. We're going from fiat to the CBDC or the digital currency era. Everybody knows that. It's been in the financial press and all the central banks agree on it. And, everybody's talking about it. So just being cognizant of all that, this series will help you do some of those pieces and kind of give you that really sort of, 2 foot deep dive into the various aspects of it to kind of get you educated there. Without further ado, we're going to wrap it up. Thanks for joining the last part of the Precious Metals Masterclass series put on by Rob Kientz of the Freedom Report.